Hello folks, and welcome back to Investment Research. I'm Simo, your equity research analyst, and today is the part 2 from yesterday's video. So I want to talk about something that really defines long-term success in investing. The question is simple but powerful. How can you invest your first $100,000 in SCHD and eventually turn it into $1 million through the power of compounding? This is not about taking crazy risks or chasing hype stocks. It's about building a strong foundation that pays you consistently, grows quietly, and gives you peace of mind. So, in my view, SCHD is one of the best tools you can use for this kind of long-term strategy. The Schwab U.S. Dividend Equity ETF focuses on high-quality American companies that have strong balance sheets and a solid record of paying and increasing dividends. When you invest in SCHD, you're basically buying small pieces of companies like PepsiCo, Texas Instruments, and Home Depot, names that have proven they can perform through good and bad markets. Historically, SCHD has returned around 9 to 10% per year when you include dividends, which is quite impressive for a low-cost steady ETF. Now, if you start with $100,000 invested in SCHD and simply let it grow, the magic of compounding starts working right away. At an average return of about 9% per year, your portfolio can double roughly every 8 years. That means you could see it reach $200,000 in 8 years, $400,000 in 16, and close to $800,000 in 24. Around the 25 to 27 year mark, you could cross the $1 million milestone even without adding any extra money. That's just the natural effect of growth and reinvested dividends. But in my opinion, the real power comes when you keep contributing. If you continue to invest, say, $500 a month while reinvesting dividends, you can reach that $1 million goal much faster, maybe in around 18 to 20 years, depending on market conditions. The reason is simple. You're not only letting your money work for you, you're constantly feeding the machine. Every extra contribution buys more shares, and every new share adds to your future dividend income. Reinvesting dividends is where the compounding really shines. SCHD pays dividends every quarter, usually with a yield of about 3.5% to 4%. On $100,000, that's around $3,500 to $4,000 per year. When you reinvest those payouts, you're buying more SCHD automatically, which means the next payout will be even higher. Over time, this cycle accelerates, and the income you earn from your dividends begins to grow faster and faster. 10 years from now, your dividends alone could be paying you more than $8,000 a year, and that's without adding any more money. The key is to stay consistent, especially during market ups and downs. SCHD, like any equity ETF, will have periods where it dips, but those dips are not a signal to run away, they're an opportunity. When the market pulls back, your reinvested dividends and monthly contributions buy shares at lower prices, setting you up for bigger gains when the market recovers. In my experience, the investors who succeed are not the ones who try to time every move, but the ones who stay patient and keep buying through every cycle. Now, in terms of allocation, SCHD can easily be the core of your portfolio. You could keep most of your capital there, maybe 80%, and use the rest for some diversification, perhaps with a total market ETF like VTI or even an international fund. That gives you broader exposure while keeping your main focus on dividend growth. Personally, I think SCHD's combination of yield, quality, and growth makes it one of the most balanced holdings out there for long-term compounding. Another habit I recommend is checking your portfolio just once or twice a year. You don't need to overanalyze it every week. A quick annual review is enough to see how your dividends are growing and to make sure everything is still aligned with your goals. If you get a bonus, a tax refund, or extra cash, add it to your investment. Every bit of capital you put in shortens the time it takes to reach that $1 million mark. Once you finally reach that point, the results are incredible. A $1 million portfolio in SCHD can generate around $35,000 per year in dividends, which means almost $3,000 a month of passive income. And because SCHD's dividends tend to increase every year, you can expect that income to rise with time, helping you keep up with inflation and even expand your lifestyle. You'll reach a point where your investments produce more income than you ever thought possible, and all you had to do was stay consistent and let time do its work. To expand on this a little further, it's critical to understand the engine under the hood. The quality screen that SCHD uses is its secret sauce. It's not just chasing the highest yields, which can often be a trap. Instead, it looks for fundamental strength like high return on equity, strong cash flow, and a 5-year history of dividend growth. This process filters out financially weaker companies and focuses on durable businesses with what we call economic moats, meaning they have a sustainable competitive advantage. This quality focus is what gives you the confidence to hold on during volatile times and what drives the consistent dividend growth over the long run. Think about the snowball effect of reinvesting dividends. In the early years, that $3,500 you reinvest might seem small, but it buys more shares. Those new shares then generate their own dividends. The following year, you are getting dividends on your original shares plus the dividends on the new shares. It's a slow process at first, but after a decade, the amount of new shares being purchased by dividends alone becomes substantial. Your original $100,000 investment becomes a larger and larger capital base that works harder for you each and every quarter. It is the most powerful and passive way to accelerate your wealth building journey. Let's also touch on the psychological benefit, which in my professional opinion is just as important as the financial mechanics. Knowing your portfolio is comprised of 100 robust companies provides a level of comfort that is hard to quantify. During a market panic when everything is red, you are not holding a speculative asset. You are holding a piece of the American economic engine. This helps you avoid the biggest mistake investors make, which is selling at the bottom out of fear. The dividend payments that keep arriving in your account every quarter act as a tangible reward for your patience, reinforcing your decision to stay the course. In my view, the formula is simple. Invest early, reinvest every dividend, add to your position regularly, and stay calm when the market moves against you. SCHD is built for investors who value stability, patience, and real long-term wealth. It's not flashy, but it's powerful. If you follow this path, your first $100,000 can grow into $1 million portfolio that generates income for the rest of your life. So that's the strategy I'd recommend. It's simple, disciplined, and proven by time. Let me know what stage of your investing journey you're at in the comments, whether you're building toward your first $10,000, $50,000, or already at 6 figures. I'd love to hear how you're approaching it. And if you found this explanation useful, make sure to subscribe to Investment Research for more clear, honest discussions about smart investing and long-term financial freedom.